Good afternoon, everyone. Welcome to this ESS Small Business webinar, COVID-19 Survival Panel, Session 10. Today I have as our special guest presenter, Nigel Abbott, a Director of Funsition. How are you today, Nigel?
I'm very well, thanks Peter, and thank you for having me on your program, greatly appreciated.
You're most welcome. The issues we're going to be talking about today are cash flow and funding issues that we expect will emerge as real issues for many businesses during 2020-21. And some of the housekeeping you might undertake within your business to help you reduce cash flow problems. And Nigel in particular will be talking about the funding issues that can be overcome with a capital raise, a equity funding for your business. So hopefully you will find this presentation very interesting and help you in your business endeavors. Funding issues, crowdsource funding might be the answer, or perhaps equity funding might be the answer, but I'm now going to introduce you to Nigel Abbott, who is going to take over from here. How are you today, Nigel?
I'm great, thanks Peter. I appreciate once again having me on the show and look forward to talking to your viewers around equity crowdfunding. So I think it's probably important we set the scene, and you know, you can say in Australia that equity crowdfunding has its training wheels off. It's been going for a couple of years. Has it really blossomed? I wouldn't say it's blossomed, but it's certainly starting to gain traction. So, you know, is equity crowdfunding in for a bit of a COVID-19 boom as businesses need to capitalise or even recapitalise? And it's a bit tricky because you don't want to sort of delight in misfortune, but interesting to note that in the UK, equity crowdfunding is a very key component in the capital market sector. And, you know, that really took off and gained traction post global financial crises because, you know, these sort of early stage and growth businesses really need capital, and it just wasn't available from traditional sources. So, you know, will we see that sort of evolve here? Well, yeah, of course, because, you know, are the banks going to be a little bit tighter? Absolutely. So, you know, where have you got to turn to be able to bring capital into your businesses? So therefore, I would say that there's quite a few businesses out there who may not have previously considered equity crowdfunding as a potential source, but will now put that on their radar. And, you know, you've also got to remember that, you know, the thing with COVID is we've all used Zoom and we're becoming much more comfortable in communication and making decisions based upon using, you know, the internet. So therefore, I would think that, you know, people are sort of starting to take financial matters into their own hands. They're comfortable with making investment choices by having all the right resources online. Now, just to give you a bit of insight in equity crowdfunding, the average investment is around $1,200, and that's your retail investors. And that just shows you that, you know, it's potentially a younger demographic that is investing in these companies that they feel comfortable with and can relate to. And they know it's high risk, but when you're only investing $1,200 around that sort of mark, you know, that kind of you're de-risking by that amount. So, you know, for a company, you have to be comfortable with having a larger share registry. So what I'd like to do now is I have put a PowerPoint together. And look, it's not a big PowerPoint, so I'm going to share my screen with you now, and we'll kick this off. Let's bring this up. Okay, can we all see that? Can you see that, Peter?
Yeah, that's up now. Yeah, yep, that's very good.
Okay, just bear with me here. Let's go back to the start. Do apologise. Okay. So a new world of investing and capital raising. So, you know, providing more of an efficient and cost-effective funding model for businesses. And of course, the upside is investors can invest in these, what we would call companies looking to reach their full potential to grow. So, you know, companies want to grow, accelerate, maximize, or in this situation, recapitalize. So equity crowdfunding does provide a viable option. So let's just have a look at a bit of a snapshot. A business can raise up to $5 million per annum, and there are some T's and C's around that, which we'll get into. A retail investor can actually invest up to $10,000 off a company per annum. So it's that sort of revolving 12 months. So I could put 10 grand in this year, and if they're going to raise more next year, I could put another 10 in. Interesting thing, in the UK, most successful crowdfunder of all time is a company called Brewdog Brewery. And that's gone back many, many times, and investors keep reinvesting. It's a $1 billion company now. There are no restrictions for sophisticated investors. The great thing is you can market and advertise these deals, and foreign investment is allowed, which is excellent. Sorry. So let's sort of have a look at some of the where equity crowdfunding fits in sort of to the funding model. And here in this particular diagram, you can see that in that kind of startup phase, you know, what I call the F cube, which is friends, family, and fools, where you're trying to raise money to kick off, and quite often you'll bootstrap it yourself. And then we move into that angel and kind of venture capital, venture funds. Now, also, you've got a question. Is it going to be more difficult during the sort of, you know, the fallout from COVID with angel investors? Well, I would anticipate that it is. And then when you get into your Series A, then you get into your Series B and C, which is private equity, venture capital, investment funds, networks, etc. And then you move on to M&A, IPO, listing, etc. So equity crowdfunding, the disruption really is around that kind of C to Series A area. And that's where it fits in nicely. And a lot of businesses, you know, in Australia that need that growth capital, that is the key area. So how do you qualify for this? As I said, well, you're allowed to raise up to around $5 million per year. But, you know, there's some key things that you need to ensure: that you've got under $25 million revenue. Oh, it'd be nice to be close to that, wouldn't it? And $25 million net tangible assets. 2 director minimum, and majority Australian. So, you know, obviously 1 Australian. You will have to publish financial and director reports. That's part of your investor relations. And then annual financial reports are audited when you raise more than 3 million in CSF capital. So if you've raised 1 in 1 year and 1 in another, when you get to that 3 million mark, you will need audited financial reports. Unlimited employee and CSF shareholders. So the good thing about the legal structure of equity crowdfunding is you can put in sophisticated investors, you can put in retail investors, your employees can come in, and all of your, you know, if your clients, service providers, everyone can pile in. And it's really important to bring that group with you, so that they're all on that journey with you. So just some of the mechanics of it. If I was to raise Nigel's Good Time business, I wanted to raise $2 million. The duration that you can raise that in is 90 days, but you can come in under. So it's up to you as the offer company to set that particular time frame within the 90 days of what you would feel comfortable. You have to set a minimum subscription. So, you know, if I had my business plan and I had growth phase 1 and 2, well, and I wanted to raise 2, I go, well, what could I really achieve? What's the minimum I could achieve? So it might be 750. So for me to fulfill my growth phase 1, I need $750,000, and that's what you need to build it around. That's your starting point. Ultimately, you want to raise 2, but you've got to set a minimum subscription. And if you want to access that funds, that has to be an achievable goal. And very importantly is the offer document, and that's really the Bible. And that's ASIC provide a template for that. And really that's like a prospectus, but much, you know, much more diluted, not as a onerous document, but really that houses all the risks, you know, your financial modeling, all the information around the business, you know, your growth, the team, and that is a very, very important document and a must-have for equity crowdfunding. So all of this actually presents good governance for your business. And that's very important, because if you're going to take on additional shareholders, you need to make sure that you've got your house in order, not just pre-transaction with equity funding, but also going forward. So that also brings up the question, you know, is equity crowdfunding the right model for me? But one thing I want you to consider is that, you know, if you're going to raise capital, who are you going to go to first? So obviously, you know, one of the opportunities which I've sort of highlighted here is you go to staff, suppliers, channel partners, customers, anyone that knows your business. They're the perfect people to target first, because in a way they've done business with you, and that's almost like conducting due diligence anyway. And, you know, you've got that goodwill with those people. So in a way you can turn customers into investors, and also on the flip, investors into customers. And you know, those people are your marketing advocates. They're out there talking about you around the barbecue saying, yeah, I've just invested in this business. So really it's about an increased share of wallet and advocacy in the ecosystem. As an example, 500 lifetime customers investing 2,000 is $1 million in equity, or even 1,000, there's $500,000 right there. So just quickly with the investors, just to recap, that is retail investors is 10K per issuer per annum, okay? No cap on the number of investments. So I, as a retail investor, can go an equity crowdfunding platform. There's no limit on how many I can invest in. I can put 5 grand here, 2 grand there, 3 grand there, but I can only put 10 into one issuer per year. And the chances of that issuer coming back the next year, well, I mean, that's, you know, that's questionable. Obviously, self-managed super fund trustees, sophisticated investors, there's no cap, which is your wholesale investors. They can advertise. There's a 5-day cooling off period. So I go, you know what, I'm not sure about that. I've got 5 days to change my mind. And if you don't meet the minimum subscription in the time frame, the money is returned to you. That's your safeguard. So go back to what I said before. $750,000. Let's say I wanted to raise that money in a 70-day time frame. I didn't achieve that goal, so therefore I can't, as an issuer, can't access that money, and those funds are returned back to those that pledged the money. So once again, that's why it's very important that you set that minimum correctly so that you can access the funds, but you have to be very transparent around what you're going to be doing with those funds. It's, you know, you're taking on investors. They have a right to know, and that's the sort of information that goes into the offer doc. Just quickly, this just shows you a typical process of what an investor goes through. So they apply for shares. Let's say, you know, it's $1 a share. I said minimum was 750, so that's, you know, 750,000 shares, $1 a share. I go through an application. I pay the money into a trust account, okay? You then go through know your customer and AML, anti-money laundering, whether it's an individual or entity, and then those funds sit there. And then obviously if you meet the minimum, then those funds are released after that time frame. You get a share certificate and you become a shareholder in that company. So, you know, the good thing is with equity crowdfunding, it gives an investor an opportunity to invest and have an ownership in a business that they feel passionate about, and they're part of that journey as it grows. So obviously you are investing for return. This isn't social, this is commercial. And if the business succeeds, ultimately the share prices increases. And you know, in investment crystallizes when a business achieves an exit event, or could pay back the shares, or it merges, or there's some sort of event that occurs where I get a return on my investment. So you must be mindful that an investor or an investor, you know, it's patient capital. You can't go in for a quick return. And once again, if you go back and look at that average investment size of around $1,200, then yes, I am probably going to be much more comfortable in not trying to get a quick return. So the question is, you know, is this suitable for your business? And as I said, you've got to get your house in order. You've got to make sure that, you know, there's nothing hidden under the mattress there, that that you're comfortable in taking on and managing a larger share pool. But there are upsides to that because of the marketing and the advocacy. So versus something like a Section 708, which is only sophisticated investors that would put larger amounts of money in, a small investor base, but they might want to have more of a say in your business. So that's a different model again, whereas you've got more shareholders with smaller portions. They don't have any control over your company, and that's important to know. So you're still in control. So basically, you know, they're the things you need to think about with your business. Is this what I want to take on? There is some work involved in getting your business organized and ready for a crowdsource funding event. You know, you've also got to think about how you market it. What's the campaign? So when you launch on a platform, what does the campaign look like? What have you got to share with people? What is it that's going to attract them and understand that your business is absolutely investable? They're all the key things. Ensuring that you've done your financial modeling correct. And, you know, that should be done with an accountant so that you're not making, you know, ridiculous claims going forward. So there is governance around all of those things to make sure that your offer document discloses all of that information. It discloses all of the risks for your business so that an investor can read that offer document and get a really good understanding of that business and make an educated decision on whether they should invest. Whether they read it or not, or how much, they have to acknowledge that they have read it before they invest. Once again, once they've invested, you have a share registry. Our company is rolling out a very interesting share registry model, but you have to manage that share registry, and there is a cost associated with managing that share registry. So, you know, you need a company to be able to manage that for you. And as I said, there is a cost associated with that, but also, you know, talking to your investors, communicating with them on a regular basis, telling them about your achievements and your milestones. That's all good marketing collateral, and it's very important because remember, if you're telling them, then they're telling others, right? And it's that effect of, you know, of snowballing. And I think that's very, very important that if you're going to take on additional shareholders, that you need to make sure that you nurture them and then you keep them updated on the business. That's critical. So look, it is an exciting opportunity for raising capital. It's great that the government has put in the right sort of legislation to create a new channel and to have, you know, another opportunity for businesses. So, you know, do your homework, and certainly if you've got any questions, feel free to, you know, reach out to Peter and myself, because we can certainly provide deep insight as into the whole process.
Thank you, Nigel.
Yeah, I think
Nigel,
we've
had a question that I had received before this, and that was from someone who's developed a new product and wants to know which is the best way to go. And he's obviously heard something about early stage innovation companies. Would you like to comment about ESSEC?
Well, ESSEC is early stage innovation companies. The upside for ESSEC is that investors pay no capital gains tax if they hold the share for a year, I believe, and you know, they can sell it inside 10 years, and also they get a 20% tax deduction. So another piece of legislation the government has implemented to give some upside to investors. And why? Because at that early stage with innovation, there is a high risk Okay, there's no two ways about it. But obviously I would see, you know, there are the businesses that are coming on to equity crowdfunding are probably more of an MVP. So they have a minimum viable product, you know, and they're starting to generate some revenue versus maybe a startup company that has a great innovation and probably doesn't have a track record. So that's where you might start to look at something like utilizing ESSIC, and the business, you know, is under $200,000 a year turnover. So, you know, you could be an MVP sitting in there as well. So, you know, I would think that with ESSIC, what we're seeing, there are some companies using equity crowdfunding, but probably more companies are using sort of under Section 708, which is more of the sophisticated investor. Would you agree with that, Peter?
Yes. Obviously, you've got to look at the various angles, but Section 708 is more experienced, sophisticated investors keen to be involved there.
Yeah, and I think they're you know, they're sophisticated, so they're very good at analysing the opportunity. So if it is a early stage business or a startup with a piece of tech or whatever, you know, they're in a much better position to gauge whether or not that is a good investment opportunity. And quite often, that's what you'll need. You'll need a big chunk of capital to help you get that to the next phase. And you know, you've also got to start to understand with equity crowdfunding, because you're pitching to retail investors, their level of understanding might be less. Therefore, it might be more of an emotional type of decision of what they invest in, and they might lean towards things that they understand better. But I would certainly, you know, explore all avenues for your business or your whatever your sort of early stage startup business is, and just get a really good understanding of what's offered in the market. But certainly happy to talk to you.
Thank you, Nigel. And Nigel, could you also comment on what your role as, that's a Funsition, role as a crowdsource funding intermediary, or indeed in equity, in early stage innovation company, in assembling investors for?
Oh, well, that's a really good point, and you know, I've missed that. So to operate an intermediary, which is really linking issuers with investors, we have to have an Australian Financial Services license, right? So, you know, we're the gatekeepers. So all those things I was talking about, offer document, ensuring that a retail investor doesn't go over the 10K, all that sort of, all those regulations that sit within the crowdsource funding intermediary, we have to be the gatekeeper for those. So our job is to have the right tech and the right governance to manage the investor and the issuer and them coming together to invest. So it's also important that as a issuer that you do have a bit of a group that you can drag along to get the raise going. You can't just rely 100% on a equity crowdfunding platform to bring everyone, okay? But what it does do is, once your campaign gets going and you start to get a little bit of traction and momentum, you know, then the crowd will start to follow when they're seeing things moving. So the good thing is you can market and you can advertise. So it's very important that you have a little bit of money set aside for marketing and advertising to get your awareness out there around your campaign. For instance, with our company, I mean, I worked in media for many years, so we have, you know, quite a few levers we can pull to help using different digital channels to market this, not just typical social channels, but using things like, you know, buying up video inventory and display inventory on publishers' sites. So, you know, looking for the right equity crowdfunding platform that has some results, or you feel that that's the right intermediary platform to work with. So make sure you do your homework around that. You know, I'm here as an advocate for the sector, not just for my own company funds-ition.
Okay, well, thank you very much, Nigel. And if anyone who's watching has got any other questions, can you please type them into chat? I should have mentioned that at the beginning, but I just had some questions there that other people had already asked me. So send them through and I'll ask Nigel those later on. I should have also welcomed the people watching us from Facebook Live today. Welcome. If you have any questions, unfortunately, you just can't type them in to join us on a live webinar, but can you send your questions to us, care of me, Peter at ESS BIZTOOLS, it's BIZTOOLS.com.au, and I'll send that question on to Nigel, and Nigel will get back to you. So I'm now going to move on and take you on to a different area. So I now want to talk to you about the second part of today's presentation, and that is cash flow problems for SMEs. Because cash flow is always a problem. That might be one of the reasons, of course, that you're interested in equity funding. But let's have a look at why it's going to cause some problems for businesses over the next couple of months. 3 months probably at the most. JobKeeper officially finishes at the 30th of September. It may get extended in parts, more likely for particular industries or regions, I heard mentioned last night. Cashflow boost, which virtually every business in Australia that is employing people is receiving payments from. That finishes at the 30th of September. I haven't seen any indication that that's going to be extended. The coronavirus SME guarantee loans that have been funded by the Reserve Bank and the Australian government, whereby they made available between them $105 billion to the banks to lend to SMEs. That arrangement ceases at the 30th of September, and any unallocated money is to be returned to the Reserve Bank. So if you think you're going to need a loan, a bank loan later this year, I'd suggest to you that you talk to your accountants now about getting an application submitted to your bank. That is a loan of up to $250,000, repayable over a 3-year period at a low interest rate. I understand the bank rates are around 4.5% for those loans. It is also 50% guaranteed by the Australian government, and there is no direct security that you as the borrower have to submit, other than I also hear one bank is asking for personal guarantees. The embargo on action against directors for non-payment of debts or taking action against directors for any offence under the Corporations Act also finishes at the 30th of September. So what's going to happen in October and November? Some people believe there's going to be a lot of action potentially from liquidators. There's also an expectation that it will be very difficult to secure loans from banks after the 30th of September. Banks have got some very wide exposure at present, and they're going to be looking to control that. I think you'll see debtors' days outstanding blow out because a lot of businesses will stop paying their suppliers, their professional advisors or whoever, because they're going to be running short of cash because of the inability to borrow more money. Leadership teams also need to be very mindful of avoiding inventory buildup within businesses. And unfortunately, I think we're going to see a rise in bad debts. So what can you do about all this? First of all, if you're running a business, please revisit your debtors management system and review it. I hope you have a written system. Unfortunately, many businesses do not, and that's why they get into trouble with their debtors. It's important that new applicants for credit are checked. At this time, I suspect there's going to be people who start getting knocked back by their traditional suppliers, and they'll be looking to take their business elsewhere. It's great to get new customers, but you really don't want someone else's problem. So please check out their credit application, their references, and make sure you get the correct contact details. A lot of this effort's left to the sales department in most organisations, and they're keen to get the sale, but at times they're not that careful about filling in the details correctly. And what that can lead to is a delay in getting documents signed and getting tax invoices delivered to the key person who can authorise the payment so that you get paid. And that's a very important part of this process. And this relates primarily to the documents, the terms of trade, the payment terms, the retention of title agreements, which are very important for the Personal Property Securities Register, which I'm going to come to in a moment. And these documents need to be signed by your customer and returned to you so that they have accepted that they owe this money and that they have got some rights, but you have also got rights. And you then may need to make a decision whether you're going to register this customer on the Personal Property Securities Register. If you don't know what that is, please contact your accountant urgently or send me an email and I'll send you some information. Because as a business operator, you should know what that's all about. And the decision that every business has to make with a new customer is whether you are going to insure that or register that customer, which is a type of insurance on that you will ultimately be able to lodge a claim for payment. The next item is one of the frustrations that I have with some businesses that I advise at times when I see the delay in getting tax invoices out. You don't have to wait until the end of the month to send the tax invoice. Send it as soon as possible. I think within 48 hours of a service being rendered or goods being supplied, you should have dispatched that tax invoice. But one of the big problems that some businesses have is that the customer has said to you that they want some additional information to accompany a tax invoice. It might be a weight certificate, it might be a health certificate, it might be something that they require. And if you don't supply that, they won't pay it. And if you also don't deliver the tax invoice and associated documentation to them by the day of the month that they specify, and this is a big issue in the mining industry. The mining industry, the company says, we want all the invoices in by the 10th day of the month and we will pay them by the end of the month. And if you go in there and give them something on the 11th or the 12th day of the month, they will not process it. It waits a full further 30 days before it will be processed. And that is really identifying the need within your office to get the system organized properly. And another key issue that many people forget is it is very important, I think, to indicate on the tax invoice the due date for payment. You want people to pay you on the invoice, not on the statement. In fact, I don't think you should be sending statements to people anymore, but that's another issue and we haven't got time for that today. But on your tax invoice, if you really want to speed up the payment process, stamp on it, this is due for payment on whatever day it is. And that is then relating to your terms of trade. If your terms of trade are 30 days from the date of the invoice, that's what you should be saying that your customer should be paying you by. And I think it's a good idea if you use one of these digital systems that companies now have available to send reminders. If not, send your own. It probably depends how many customers you've got. But send a reminder 5 days prior to the due date that your invoice is due for payment in 5 days' time. And also follow up if they don't pay you. It always amazes me the number of businesses that are not following up. Someone doesn't pay them, they just forget about it. They worry about it at the end of the month. I think you should be contacting them then. They may not have got all the documentation they required. That's why they didn't pay. So as soon as that phone call is made, you will find out what the problem is, and you can hopefully rectify it and supply whatever additional information the customer wanted. And then hopefully they'll make payment. If you wait for another month to find out that you didn't supply a weight certificate or some other documentation that they had specified when they signed on with you as a customer, seems a bit silly to me, because you've held up receiving payment. Calculate the debtors days outstanding. It's a very important figure, and you should know that within 48 days of the end of the month. I think the debtors days outstanding should be one of the major key performance indicators within your business. Every member of the leadership team and the sales team should know what that figure is each month, and more importantly, what it was budgeted at. If the budget is 31 days and you're running at 37, you should be screaming it from the rooftops to all of your team. We are miles over our KPI for debtors days outstanding, and then start drilling down to see what the problem is. Is it taking 7 days to send tax invoices? That will cause a delay in getting payments. Have we had 20% of our customers complain that they never got whatever additional information was supposed to be supplied to them? Did someone stop stamping on the tax invoice before it went to the customer the due date for payment? All those things can be contributing factors to you not getting paid. And the senior leadership team, I think, has a real role to play in all this, especially as we go into this post-COVID-19 period. I think the senior leadership team should be the people telephoning these customers, making contact with them again, seeing how they're going, and more importantly, making arrangements for that money to be paid. If a junior salesperson or a junior in the office rings, it will not get the level of attention that it deserves from your point of view. And the other thing is, it's giving your leadership team contact with customers and being able to talk to them and find out how they're going, what they think of your products, what could you be doing differently. So that's a comment on the debtors management side of things, which will help improve your cash flow. Inventory, I think, can be a real problem. I've called it the cash hole. Sometimes you might call it a dog's breakfast. It can be a problem area because no one is really taking control of it, rather than a more junior employee who's classified as the storeman. It needs to have a higher level of responsibility, because you can have hundreds of thousands of dollars, if not millions of dollars, tied up in inventory. And all put together in one figure, it looks like a big blob of jelly. But it needs to be broken down. It needs to be analyzed into individual departments and then into products, so that you can monitor it and manage it. It's got to be managed, not just left in a huge warehouse that no one's really worried about, if you want to limit your cash flow problems. So review the amount that you've budgeted. If you've budgeted that $700,000 in the month of June or July is the investment in inventory, and it's currently sitting at $830,000, what are you going to do about it? You need to reduce it. So the level of investment, I think you should be making sure leadership is monitoring each week, asking some questions. If sales have slowed down in particular categories, reduce the purchasing. Unfortunately, with the use of computers, there's a lot of automatic reordering going on. Now, that's all right if it's geared to sales, and as long as the sales department wants that particular product back so they can try to sell it again. But there may have been some other reasons why that sales of that particular product have reduced, and therefore you should be reducing your purchasing. And if sales have slowed down, make it a think tank issue with the leadership team, with the sales department. What are we going to do to clear this stock? Because if you don't, it'll still be there in all probability in a year's time. And then it might be last season's fashions and no one will buy it. So you need to clear that stock as soon as possible. It's eating its head off. With storage costs and even with very low interest rates, it's still costing money and it's eating up valuable space. Stock turn days are an important key performance indicator. You can have an overall stock turn, which might be 2 or some other figure, but I think the important thing is breaking it into departments and then probably individual line items within a department. Because some departments you'll be looking for a far faster stock turn and analysing it and making sure that everyone is conscious of this on a weekly basis. So they're the suggestions that I'm making to you on some strategies that you can implement within your business to try to improve your management of your cash flow. 2 areas that are very close to the control of the leadership team, but they're not items that the leadership teams in businesses always get involved in. I would be suggesting you do that, particularly as I believe, and so do many other commentators, that it's going to be difficult financing businesses in the 2020-21 financial year. And that is why you also might look at equity funding that Nigel has talked about today. Now, I'm just going to check to see whether we've got any questions at this stage. I can't see that we've got any. If you have any questions, can you please type them in to the question and answers, and I will get back to you. Let's do a COVID-19 news update. The coronavirus, I just mentioned that SME guarantee loan offers cease at the 30th of September. To negotiate one of these loans with your bank, you'll need a business plan or at least a dot point business plan, budgets and cash flow forecasts looking at the next 3 years, because under the deal that the Reserve Bank has negotiated with the banks, those loans are for a 3-year period for working capital purposes. So they'll need that sort of documentation. If you haven't qualified for JobKeeper in March, April, May, you can still qualify if your turnover in a month has dropped by more than 30% when compared to the same month in 2019. If you have noticed that drop in turnover and you would like to apply for JobKeeper, please see your accountant and get the necessary application to go to the tax office completed. Just bear in mind that if you qualify for JobKeeper, you will be eligible for $1,500 per fortnight per employee, but you then have to be paying that amount to those employees. And your JobKeeper payments would only commence from that particular month. I think it's a good idea for many of you in running small businesses to be thinking about what you could do for home builders and renovators, because they are now eligible for a $25,000 grant from the federal government. And there are plenty of state grants out there for new home builders. In some cases, building up to $40,000 to $45,000. So what promotions can you offer? The federal government's $25,000 is available now. There's been some delays in getting that activated because the state government departments had to then develop systems to synchronize with the federal government control of this, and in particular the tax office. But there is an opportunity for you to be promoting your goods and services that might fit under the costs involved in the building of a new home, or renovations, or even selling the land to people to build their new house on, as long as it all fits within the upper limits that the federal government has defined. Each week when these webinars, and this is the 10th weekly webinar we've operated for businesses, we look at some challenges. I think your challenge for today is to make sure that the preparation of your budgets and cash flow forecasts for the new fiscal year, which starts in 1 week's time, have been prepared. You could start preparing these yourself and then talk to your accountant, or you may have an accounting person in-house, or you may be able to do it yourself, but start preparing your budgets. I'd factor in some delays in getting paid by your credit customers, your debtors, and see what your process is going to look like. But if you're anticipating some major capital expenditure, make sure that's put into the cash flow forecast. If you're anticipating a major research and development activity, budget for that, and see what the end result is. See what your cash flow shortage might be, and then think about where you're going to get that money from. You may be able to apply for a coronavirus SME guarantee loan now if that cash flow deficit's going to be under $250,000, and get that loan now and use that for your funding purposes. Just remember, it's got to be repaid in 3 years. Or you might like to think about equity funding along the lines that Nigel Abbott was talking about a little earlier. And if so, you need to start thinking about that. You're going to need to have your house tidied up, your business house tidied up as far as the records, your business plan, budgets, cash flow forecasts, an understanding of the types of opportunities there are to raise capital. Nigel's summarised those quite clearly today. Section 708 of the Corporations Act, a maximum of $2 million raised over a 12-month period from a maximum of 20 investors. Crowdsource funding equity raising up to $5 million, really no limit on the number of shareholders. The only limit is a retail investor can invest up to $10,000. And if you're a small startup business that's invented a new product, process, or service, there is a special entity that's been created by the federal government called Early Stage Innovation Company that Nigel also made some comments on. If you're interested in any of these activities, you could talk to your accountant, you could contact me, or you could contact Nigel for a discussion. And on our website, we'll have details of Nigel's contact details. But this all starts with you seriously looking at a budget and cash flow forecast for 2020-21. Review the processes that you might be able to improve your control over your cash flow by looking at your debtors management system. Go through those key points that I mentioned and do an audit on your firm this afternoon or tomorrow morning. How long does it take? Is all those processes working? An extra day added here and there through that process will blow your debtors days outstanding out, because people will not pay for any products or services that you supply to them until they have received the documentation in the format that they have asked you to supply it to them. And just make sure that in these difficult trading circumstances, you are closely monitoring your investment in inventory. It can blow out very quickly if it's not being controlled. Seriously consider, we've already talked about that, external funding for your business that you might be able to get yourself investment ready for whether it's Section 708, crowdsource funding, equity raising, early stage innovation companies, under this general heading, equity funding. And just remember, with equity funding, there's no security required. There's no personal guarantees. I should have added there's no interest to be paid each month. And you don't need to own 100% of a business to generate wealth. What you will be doing is allocating shares in your company to investors who have put part of their life savings into your business. They will need to know that you have a vision and that you are very keen and committed to giving your business the best opportunity to succeed. So I'd be suggesting you allocate yourself some quality time. And not enough business people do this. Turn off your phone, get away from your office for a while, or lock the door and say, do not disturb me unless the place is on fire. And spend 1, 2, 3 hours thinking through things through. Make out a list. One list might be things to discuss with your accountant. Make out a list of things you might discuss with a person you consider to be your mentor, your business mentor. And work your way through it and try to determine strategies. This is going to be one of the toughest years that Australians have ever had to conduct businesses in, 2020-21. You need to give yourself some time to think clearly, to plan the process now. And please don't wait until the end of September, because if you haven't put strategies in place and have arrangements underway before the end of September, I suspect that there could be quite a few problems around. So do it, please, now. ESS Small Business, we're here to assist SMEs. We have a debtors management product package, which is available. You can basically install it, you badge it with your name, and it covers everything I talked about today on debtors management and a whole lot more, because it gives you all the forms and the processes. Inventory management system, not as detailed as debtors, but we do have a inventory management system. The COVID-19 survival plan is part of our package. And we do have people contact us after these webinars and say to us, well, you keep on telling us to go and talk to our accountants. Our accountants keep on telling us they're only interested in income tax. If that's the response you're getting, and income tax is very important, but there are accountants around Australia who can offer a broader range of professional services. They will be able to assist you on offering, on you understanding how these other processes work, particularly with equity funding and debtors review, etc. If you want their names, please send me an email, peter@essbiztools.com.au, and I will supply you the names of some accountants who are our subscribers within ESS BizTools, who are committed to supplying a broader range of professional services to you, and you can then make contact with them. So you can visit our website, www.esssmallbusiness.com.au. We have another webinar next Wednesday, the 1st of July, start of a whole new fiscal year, 12 noon, AEST. The presenters are going to be Paul Barnaby, who's a prescriptive accountant, and the representative of Plan Guru, a budget cash flow projected balance sheet software company. He's going to be talking about using three-way financial forecasts to predict the financial future of your business. And we have Matthew Karakalakis, a partner in AMK Law, who's going to be talking on legal issues confronting businesses in the post-COVID-19 environment. So both of those gentlemen are talking in our next webinar next week. Nigel, thank you very much for being with us today. I'll just go back so I can, if you've got anything further you'd like to comment or?
No, thanks very much for having me. And if anyone's got any questions and wants to learn more and more, you know, delve into the detail more, please feel free to reach out. I know you'll put my contact details up. So yeah, thanks again for having me. Appreciate it. And
you can give people your contact details now then, if you like, also. Thanks, Nigel.
oh yeah, well, just contact me, nigel.abbott, ABBOTT, at fundzition.com, FUNDSITION.com, nigel.abbott at fundzition.com.
Okay, well, thank you very much, Nigel. It's great to see you again.
Yeah, you too.
Nigel did do some interviews with me some time ago. He interviewed me, or arranged it, when he had that other business that he's referring to. So he does know a lot about businesses and startups and crowdsource funding, and or equity funding overall, looking at all these potential activities. So thanks very much, Nigel, and I'll see you around.
Okay,
thank you. To all of you, thank you very much for being with us today. Thank you, the people watching this as a live feed. If you are watching this very early of a morning, like some people tell me they do, don't ring me then. But if you do have any questions, please send me an email, peter@essbiztools.com.au, and I will get back to you. Wait there, we do have a question by the looks. Oh no, someone just said, thank you to that person. Okay, we'll see you all later on. Bye-bye.